How is everybody doing today? Welcome back to another episode of The Banker Next Door. I'm your host, Dr. Joe Berquist. So today I wanted to talk to everybody about a potential opportunity for community banks in the multifamily lending world. Right now you have a situation where national banks and large regional banks are really beginning to pull back on multifamily lending, which could leave a big opportunity for community banks. But what are some of the tips or perhaps best ways for them to go about going down the road of really getting more invested in the multifamily lending area? So I saw a blog post from PCBB on this very topic, and I wanted to share this with everybody, see if we could go through this. So this is titled, "Can You Fill the Multifamily Lending Gap?" Now, I do have a link to this blog post in the description down below if you'd like to go take a look at it. And the summary here reads, regional and national banks have pulled back from multifamily lending, and that's created an opportunity for banks. We discuss how banks can thrive in this niche. So they go through a little example here, but then they come for, community banks as they step into the void of multifamily lending left by national and regional banks. The larger institutions are lending more cautiously, likely in response to the stress of higher interest rates on existing debt and resulting tighter liquidity. They're also responding to current conditions in the construction industry itself, which is swimming against a tide of higher material costs, rising insurance premiums, and labor shortages. Recent adjustments to rent stabilization rules in some cities have limited landlords' ability to increase rental income on their properties. Some geographical areas have too many rentals, so developers must carefully consider the risks that local markets present. While all of these pressures on the multifamily housing market have caused a decline in housing starts, the National Association of Home Builders is anticipating 6% growth in this market in 2026. This potentially means banks could become part of the comeback of multifamily housing starts. And here we have a great chart here of multifamily housing starts from 2023 to 2026. And you can see here we had 472,000 starts in 2023, dropping 25% to 355,000 in 24, dropping 11% to 317,000 in 2025, and potentially growing by 6% to 336,000 in 2026. So with this little bit of increase here in multifamily housing starts, how can community banks get involved with this? So then we go into banks fill the multifamily lending need. So these factors have combined to give property owners and developers a dearth of options for financing new construction loans or refinancing existing debt. Banks have stepped into the gap, expanding relationships and filling a void left by larger banks and CRE and multifamily lending. First and foremost, banks are valuable partners to developers and investors because they are willing to lend where larger financial institutions may not be doing business. Yet, they bring other advantages as well. They're generally giving us far better terms than we could get from the regionals and certainly the big national banks, says Michael Procopio, CEO of Procopio Companies, a development firm in Middleton, Massachusetts. He added that larger lenders often expect borrowers to fit into their existing programs. Banks, by contrast, are usually willing to create a structure that can make a loan work, possibly floating, capping, or swapping the rate. They're just so flexible. And for us, what that gives us is confidence to close, Procopio says. So financing for a large apartment building might push up against a bank's lending limits. So some local lenders are building participation loans involving multifamily banks of similar size. A common loan structure might involve an interest-only loan for 48 months with a 12-month extension option. A borrower that reaches break even or better debt coverage at that juncture can extend the loan for another 12 months, shifting to a 30-year amortization. According to Independent Banker, most lenders are using loan-to-cost ratios of 60% to 65%. Now, what are some tips for succeeding in the CRE and multifamily lending for community banks? So in addition to thinking creatively and collaboratively, there are other things that banks should keep in mind as part of their recipe for successfully lending to CRE and multifamily projects. Number one, banks are renowned for their local knowledge. Use what you know of your community to track real estate trends, economic shifts, zoning changes, and areas of demand and oversupply to benefit your business customers and help prevent your bank from backing a suboptimal project. Number two, apartment buildings are a classic multifamily build. Don't forget workforce housing, duplexes and triplexes, affordable housing, senior housing, older properties in need of refreshment, and build to rent projects on your list of potential borrowers. And number three, tax incentives to build affordable housing or redevelop vacant or abandoned property can help fund a project that has a workable ratio of debt to equity. The Fed will eventually lower interest rates, possibly as soon as this week's, which they did. And many experts expect the 10-year Treasury to reach 4.08% around the first quarter of 26, which we're not that far away from that. Big banks will become interested in CRA and multifamily lending again. By building strong relationships now, however, banks can position themselves to keep many of the business connections they develop. Big banks have taken a step back from CRE and multifamily lending, probably in response to higher interest rates on existing debt and resulting tighter liquidity, as well as conditions within the construction industry. Banks have an opportunity to use their local knowledge and ability to build relationships to step into that gap. So, yes, I think this is a great article. I think there is a great opportunity here for a lot of community banks to potentially jump into this fray. They do have some issues, though. Number one is a lot of community banks have kind of shied away from construction in recent years. Reason being is that they're on a technical aspect. Construction projects get labeled in your loan portfolio as what's known as HVCRE, which is high volatility commercial real estate. When you have HVCRE in your loan portfolio, you have to set aside additional capital to cover that potentially volatile or what are deemed riskier types of commercial real estate projects. Not the end of the world at the end of the day, but it does play into thinking around how much risk does the bank want to take. So, and again, the other thing is participations. Every single bank out there has what's called a legal lending limit. The legal lending limit is a calculation based on a couple factors, but mainly the assets, meaning the loans that the banks has on their books. So say a $1 billion community bank has a legal lending limit of, we'll say $11 million. There is also another piece to this. Even though a bank has a legal lending limit, they also have what's called an in-house limit. And banks generally like to set that because they don't want to constantly be bumping up against their legal lending limit with their borrowers, because basically the regulators don't really like that. It kind of shows again, you want to build trust and rapport with your regulators, right? And your auditors, not just the regulators, but your auditors. And you want to show them that you're a very responsible lender and that you're really looking to manage your risk appropriately. And therefore you don't always want to be bumping up against the legal lending limit. So in order to kind of work within those parameters, banks like to set an in-house limit. So if your legal lending limit is $11 million, the in-house limit might be $10 million to any one borrower. And that way, that gives you some flexibility that if you do go over the $10 million, you still have another million to kind of work with there before you would have to get into a participation type situation. But the reason why you have to do participations is because a deal may be over the bank's legal lending limit. Like, for example, you may have an apartment building, an apartment complex. It might be a $15 million apartment complex. Bank has a legal lending limit of $11 million. Well, the bank might go, okay, let's call up one of our neighbor banks over here. Let's see if we could do a participation. And I'll tell you what, we will take $8 million if you guys will take $7 million. So that way you're still what's called the lead bank in that participation. You have the majority of the loan. You got the $8 million, and you sell $7 million to the other bank. Thus, you're keeping yourself under your legal lending limit, and you're also giving yourself a little bit of breathing room should that borrower maybe come back, want to do another deal, or maybe they need additional money for something else. Like, you're giving yourself some ability to being able to keep lending to that borrower. So you have to think about that, but then also some of the other potential projects, as they mention in here, workforce housing, duplexes and triplexes, or quads. I love quads. Affordable housing, senior housing, older properties in need of refreshment, and build to rent projects. Again, a lot of that stuff is great stuff. And I think a lot of the banks that don't want to take the maybe the higher risk with doing full-blown construction lending, they'll focus on a lot more of this stuff, student housing, it's basically student housing apartment projects, but affordable housing projects, senior housing, 55, that'd be like 55 and up developments. Just a lot of older apartment buildings. Like that's always been one of my favorite things as a lender is older apartment buildings. I love when people just buy an existing apartment building and they just give it the fresh coat of paint. They come into it. All right, we're going to revamp the units. We'll hang all new doors. We'll do all new carpet, all new paint. Maybe we'll update some of the mechanicals. Maybe we put in a new, maybe we put in a washer and dryer, put in a new heating system or air conditioning units or a water heater, whatever the case may be. They upgrade the kitchens and the bathrooms, and voila, now you have a much better, apartment building, gets higher rents, throws off higher cash flow. The bank gets a better loan. All this, so everything works in that kind of scenario. So, but again, I really like this because I really do think that there is a really nice opportunity for banks, for particularly community banks in the multifamily space that could be there for maybe about another year before that, before that window maybe closes. We'll have to see. But with that being said, I will wrap this episode up by saying if you like this episode, please make sure to like, share, and subscribe, as that always helps the channel. Remember, we are on YouTube, Rumble, and all major podcast platforms. Please be sure to leave your comments down below, as I always love getting back to everybody. And as always, make sure to check out some of the other content on the channel. I thank you so much for listening. I hope you have a great day out there, and I will see you again real soon. Thanks a lot.